All right. Hey, everybody. My name is Scott Lacy. I work for the Arkansas Small Business and Technology Development Center. Thank you so much for registering for this webinar. I'm just going to tell you a little bit about the ASBTDC, get some housekeeping stuff out of the way, and then we're going to dive into the cash flow portion of the webinar today. So welcome to this program of the University of Arkansas, ASBTDC. We're really happy to be able to bring you these educational tools to help us support our small businesses. If you don't know about the SBDC, it's a one-stop shop for startups and existing small businesses. We're associated with the University of Arkansas, as well as the Small Business Administration of the U.S. government. We're also part of a nationwide network of more than 1,000 small business centers. We are partially funded by the SBA, by the University of Arkansas, as well as by some local foundations. I'm an employee of the University of Arkansas, even though our funding comes from several different sources. Locally, we offer complimentary one-on-one consulting services and programs that cover relevant topics to small businesses and entrepreneurs. And we would just encourage you to visit our website listed on the screen there at sbtdc.uark.edu to sign up for a consultation. If you haven't had one already, you can just click that button in the right top-hand corner of our website and sign up as a client. We'd be more than happy to talk to you. We've got people that cover everything from finance, marketing, social media, branding, consumer packaged goods, just general business strategy, some legal stuff, compliance things, taxes, pretty much anything that you could think about involving your business. We've got somebody on staff who would love to speak with speak with you about those things. So please feel free to get in touch with us. So again, my name is Scott, and I've been with the center for about 2 years now. My background is primarily in finance. I've owned two of my own small businesses. I ran the numbers and the operations. My wife did most of the product development and the marketing. So that was a lot of fun to do together. In business together for 10 years and still married. So quite an accomplishment there. I like to brag about a little bit. That's a little bit about my background and doing this now, and really enjoy helping people with their financial management, applying for loans and getting financing and all that kind of thing. All right, so today we're going to cover which was our fall finance series. I need to change to our spring finance series. Sorry about that. But it's called the number one killer of small businesses, cash flow. It is the number one thing that kills small businesses, is running out of money. So before we get into that, there are two places that you can ask questions. So down the bottom of your screen, we've got this chat box here, and we've also got this Q&A box here. And if you just click one of those, you can ask a question and I will answer it at the end of the webinar. So thanks again so much for joining us. And I'm going to get a quick screenshot of something real quick. There we go. And that's done. All right. So what is so important about cash? Well, cash for your business is like gas for your car. Your business cannot run without cash, just like your car cannot run without gas. It's the same thing for your business as that gas is for a car. You literally can't run without it. You've always got to have it. So you want to monitor it very, very closely. It's just like, a piggy bank is your gas tank. Really simple analogy right there. You've got to keep putting cash in from one of the different sources of cash in order to keep your business going. So why is cash so important? So what a lot of people don't realize is that businesses can actually have a net profit loss, but still remain open. So businesses can actually lose money, but still remain open through finding other sources of cash. We're going to get into that here in just a minute. But if you don't have any cash, you can't operate your business. So you could actually show a net loss on your profit and loss statement, but get cash from other sources of funding and still be able to operate. Whereas if you don't have any cash, you can't operate. So that's why cash is really important. So why do businesses run out of cash? So here's the primary reasons that people run out of cash. And I'm just going to sort of get right into it for you guys. The number one reason that businesses run out of cash, the number one cause of people running out of cash, is because they fail to actively manage the cash in their business, and they fail to actively manage their business. And they fail to actively manage the business by failing to do the following things. They fail to even record their transactions in their business, the incoming and the outgoing cash or money. They just fail to do the bookkeeping in general. People just don't do it. They don't actively manage it. It stresses people out. They don't like it. It's not fun. It's boring. It's not why you went into business to manage cash, and people just fail to do that. And You turn around one day and you realize you don't have enough cash to pay your bills because you haven't been actively recording your transactions to be able to make good decisions about your business. They fail to review their financial situation on a regular basis, fail to budget, and fail to forecast. So this is why people run out of cash. So if you're one of those people that's thinking to yourself, man, I don't enjoy this, it stresses me out. I wish somebody else could just do it for me, or any one of those kind of thoughts. Just keep in mind that the longer you put this off, the higher your chances are that your business is going to fail, because you're going to run out of cash eventually if you're not actively managing it. Managing a household budget for me can be stressful at times when money's tight. I don't like to do it, but it's that active management sometimes that keeps us out of trouble, but helps us make good decisions. The same principles apply to your business. You've got to actively manage your financial resources in order to be successful in business. So that's why people run out of business. If you're not doing those things right now, you need to be. And here at the center, I can help you put those systems in place to be able to do that. And I can also connect you with some good accountants to be able to help you do that as well. I'd love to do that with you if you want to get in touch. So sometimes people just misunderstand their financial data. And so that's why I'm anticipating a lot of you are here today, is that you don't understand your financial data as well as you would like to. And so you want to understand it better. And so you've signed up for this webinar. So that's great. It's a wonderful first step for you to be here today. And just like I said a minute ago, the number two reason, or the other reason that people run out of cash, is just because they fail to plan, which you've all heard the saying, failure plan is a plan to fail. So the first way that people misunderstand their financial data is they misunderstand, or they don't understand, or they've never been taught or didn't know. And it's okay if you don't know, that's why you're here. And it's great that you're here, is not understanding the difference between the income statement, which is one of our three main financial statements, and the cash flow statement, which is another one of our three main financial statements. So we're going to talk about both of those here today, what the differences are, and how you can make sure you're looking at those properly to ensure that you're not running out of cash. The other thing that most people misunderstand as well is that profit does not equal cash. So not understanding the difference between profit versus cash. Cash is usually your bank account balance, what you've got on hand, whereas profit is a measure of operational efficiency that shows on your income statement or your profit and loss statement. And those two things aren't the same thing, but a lot of people like to go into their QuickBooks or get their P&L from their tax statement or from their accountant on a regular basis, and they look at that and, oh, I'm profitable, I must have cash in the bank. And a lot of times people go and look at the bank and they don't have as much cash as they have profit, and they don't know why. And they wind up not having enough cash to pay their bills. And then you come to us and we help you fix it. So like I said, the other reason is having a failure to plan, and planning involves two primary things when it comes to cash. And we're going to get into some specific examples here in a minute, but failing to forecast your sales and your cash needs, and also failing to budget your expenses. So failing to forecast your sales and your cash needs, which is also a failure to budget for your expenses, okay? So before we dive into how to manage your cash actively, we need to understand really quickly two different methods of accounting that some of you probably have dealt with on a regular basis, and some of you may not have dealt with on a regular basis. So real quick, I need to do something. We've got some more attendees that got here just a little bit late. I need to take care of those real quick. Okay, that's great. And again, if you guys have any questions, you can ask them in this chat box here or this Q&A box here at the bottom of your Zoom screen. So accounting is done two different ways. In most of small businesses, it's done in the method that we call the cash method. And then as people grow, sometimes they get into the accrual method. The bottom line of these two things comes down to when you record the transaction or when you record the sale or the expense. So under the cash method, you only record the sale or expense in your books when you actually give the cash or receive the cash. So that's pretty simple, right? And the accrual method, it doesn't matter when cash changes hands. It just matters when the revenue is earned or the expenses are accrued. That's when you record the transaction. So for instance, let's say that you purchase something from a supplier, but you don't give them the cash. If you're on the accrual method, you would go ahead and record that expense in the current month. Whereas if you were on the cash method, you would not record that expense until you actually handed over the cash to the supplier. So two different methods there. Most of you are probably dealing with a cash basis of accounting. And that's something really important to know as you as you are looking at your QuickBooks or whatever software you're using to manage your to manage the finances of your business. If you're using the cash method, it's going to tell you one set of facts. If you're using the accrual method, it's going to show you the same set of facts, just in a little bit different way. And so there's also, when you're managing the cash in your business, it's important to keep the following in mind, which is that there are different sources of cash for your business. A lot of people don't realize, or it just, it makes sense when you think about it, but it's kind of one of those things you maybe need to have said, before it really kind of clicks. And that's that there are more sources of cash for your business than just the profits from your sales. So everybody knows, go into business to make money. The way that I make money is I have a product that I sell for more than it cost me to acquire. And that difference between what I acquired it for and what I sold it for is my profit. And there's actually more sources of cash for your business than just that profit. So you can get cash from taking out debt. So you might go to a bank, take out a loan or a line of credit. You might even have a credit card that gives you access to cash on a regular basis as you need to spend that money. And so there's access to cash there when you're short on your profits. There's also access to cash through getting outside investment, whether through family or friends or actual investors, and you can exchange equity in your business or shares in your business for that investment. And there's also other sources of cash called, crowdfunding or grants, or just, gifts from family and friends, and that kind of thing. So if you're running short on cash, I would encourage you to explore these different sources of cash so that you've got enough room to be able to pay your bills in the coming months. Okay. So now we're going to look at the difference between the income statement and the cash flow statement, and the difference between profit and cash. So real quick, here is an example, a very simplified income statement, also known as a profit and loss statement. And remember what I said, profit does not equal cash. So before we can understand the difference between profit and cash, we need to understand what profit is. So profit comes from the income statement, also known as the profit and loss statement. And the income statement, or the P&L, is just a statement. It's a financial statement or a financial report that shows us the amount of money that we made off of the things that we sold after we paid our expenses. So at the top here, you can see we've got our revenue, which is our total sales, and then the cost of goods sold, which is the price that we paid for the goods that we sold in that period. And that gives us our gross revenue. So our revenue minus our cost of goods sold, or minus, the goods that we sold, minus our sales, general admin expenses. So like rent, utilities, insurance, sales salaries, office staff salaries, that kind of thing. Depreciation on equipment, interest payments on any loans, running credit cards. That gives us our operating profit. And then we pay our taxes, and after we pay our taxes, we get our net profit. So the profit is the money that we show on our financial statement or report that is left over after we have had sales and paid our expenses. That's what profit is, and it's different than cash, which we're going to get into here in just a sec. So this is another financial statement called the statement of cash flows, and this shows, in comparison to the P&L, the profit and loss statement, only inflows and outflows of actual cash amount. So what a lot of people don't know, and this is key, is that there are actually items that show up on the P&L that don't actually represent real cash flowing in and out of the business. And I'm going to show you some examples of those here in just a sec. What the statement of cash flow does is it shows all of those actual cash inflows and outflows, and only actual cash inflows and outflows. So this is a really helpful thing to be able to see. And so the way that the statement of cash flows is set up is it starts with a net profit, and then it makes adjustment for cash and non-cash items that are operating activities, investing activities, and financing activities. And then it shows you the net cash flow. So it starts with net profit, makes adjustments for things that are on the P&L that are cash and non-cash to give you the net cash flow. So here are some differences between the income statement and the cash flow statement. So if you're sitting there and you came to this webinar, or you signed up for this webinar today going, I'm one of those people that I'm showing a net profit, but I'm not showing the corresponding cash in my bank account. Here are some things that you can look at in comparing those two statements that may show you where that cash is disappearing to. So here are some cash outflows that your business has that are not going to appear on your income statement. So let me say that again. These are 4 items that I'm going to go through with you that you have to pay for with cash every single month. But those things that you pay for, these things specifically do not show up on your income statement. So you could show a net profit, but actually have a net cash loss because of these one or all of these 4 items. So the first one is inventory purchases. So if you've got a business that sells things and you go out and you make a big inventory purchase, you go out and make a big inventory purchase, that inventory purchase is not going to show up on your income statement. And the reason is because on the income statement, we only account for things that we have actually sold. So if you haven't actually sold that item in that period, it is not going to be accounted for on the P&L. On the P&L or on the income statement, all that shows up is an expense of the items that we sold is the actual items we sold in that period, the total inventory purchase. So if you purchased, 100 units of a product that you're selling, and then you sold it, the expense for those products is not going to show up on your P&L until you actually sell those things. However, the entirety of the cash outflow of that purchase for that period will show up on the cash flow statement, just not on the P&L. So the next thing that might show up on your cash flow statement, but not on your income statement, that could be a drain of cash that you're not catching, is principal payment on loans. So as many of you probably know, and some of you may not know, and that's okay. When you take out a loan from a credit card company or from a bank or from anybody else, and then you pay that back in monthly installments, there's that single monthly payment. Let's just say it's $500. Let's say it's just a car payment. Let's say you've got a $500 car payment. When you pay that $500 every single month, you're actually paying for 2 things with that one payment. One thing you're paying for is to repay the money on the loan, and that portion is called the principal payment. There's another portion in that $500 that is the interest payment, which is the fee that you're paying the lender in order to borrow that money. So even though you may be paying back $500 a month, maybe only $350 a month is going to the principal payment to actually pay back the money that you borrowed, and $150 might be going as the fee to pay the interest off to the person that you borrowed it from. And so that $350 principal payment is not going to show up on the income statement. And there's some accounting rules to explain why that I'm not going to get into right now. But just keep in mind that that principal portion of the payment is not going to show up on the P&L. It's only going to show up on the cash flow statement. However, the interest payment, the interest portion, will show up on the income statement as well as on the cash flow statement. So when you're looking at your income statement, let's say you've got a $500 net profit or a $350 net profit, that's great, but you've also got this loan that you paid for. You may actually have just kind of broken even on your cash flow because of that $350 principal payment that only showed up on the cash flow statement. So the next one is credit card payments, which operate very similarly to the principal payments, and the loan payments back to banks. You're just paying a credit card instead of a bank. And so if you're paying a credit card payment every month, unless you're paying it off in full, if you are paying some interest on it, that lump sum payment that you're paying back to the credit card company will not show up on your P&L if it's being reported correctly. It will only show up on the cash flow statement. And the next one is sales tax payable. Sales tax is just a pass through. So people, are giving you money that you just turn around and give to the government. It's not viewed as real income for the business. It's not viewed as real revenue for the business. The sales tax portion is not. You're just primarily holding those dollars to be able to pass on to the government. And because of that, the sales tax money that you receive should not be recorded the payable that you're accruing is not showing on the P&L as an expense. It's only showing up on the cash flow statement as an outflow. So sales tax payable is not something that's going to show up there. All right, and so here's some non-cash items on the income statement. So these are things that are going to be on your income statement that don't actually represent a real outflow of cash, but they are expenses because of accounting rules. So one is depreciation. So that's in the case that you buy some equipment or like a car or something. And over time, the value of that item depreciates, or the value of that item goes down because it's being used, it's got wear and tear on it, the market value of it isn't as high. And so you have to expense that somehow. And the way that you expense that is through depreciation. And that expense, according to accounting rules, is supposed to be reflected on the P&L, even though it's a non-cash expense. You're not actually paying for it until you replace the item, but it shows up on the P&L. Sales on credit is another non-cash item. So if you sell somebody something and you say, hey, just pay me 10% now and 90% in a month, then that is going to be, if you're on the accrual method of accounting, you're going to record that sale now, even though you haven't received the cash, even though you haven't received the cash yet. And so if you do a lot of selling on credit, you might show a net profit, but then when you go to look at your cash flow statement, you're actually cash short because you actually haven't received that cash yet. So sales on credit. Another one is expenses paid on credit. If you're on the accrual method, and let's say you get charged, like an entire, let's see what would be an expense. Let's just say your utility company gives you 60 days to pay the bill. And you're on the accrual method, you could record that expense on the current month's P&L, but you haven't actually paid a cash outflow yet to the utility company. You actually haven't given them cash yet. So that's not going to be reflected on your cash flow statement because no cash has changed hands. So you could actually look like you're more of a net loss because of those expenses paid, when in actuality, you've got cash because you haven't paid the cash yet. So those are some differences between them. And it's usually these things that cause most business owners to think, hey, I'm profitable, but I don't have cash. Why? These are the usual reasons. So just keep in mind, profit does not equal cash. Keep that in mind. Always remember it, and don't forget it. Just because you're showing a net profit on your P&L does not mean that you are going to have that amount of cash in your bank account, nor does it mean that you're going to have the cash to pay your bills. So how do you not run out of cash? That's the question everybody wants to know. So first of all, actively manage your finances of your business. Take care of it. I know it's stressful. I know it's not a lot of fun for most people, but the number one way that you can not run out of cash is to make sure you're actively managing it. And I can help you do that. If you want to get in touch, we can implement some systems and solve those problems for you. Really happy to do that. So the other thing that you can do, the other two things that you can do is do financial forecasting. What is financial forecasting? Sounds like a really fancy term, right? It's actually not. It's actually just sitting down and trying to anticipate your sales and anticipate your expenses in order to be able to anticipate your net profit and your cash at the end of the month. And the other one is budgeting. So just like a family budget, you know how much money you're bringing in every month for your household. So you want to make sure that you're not spending more than you bring in a given month. So you want to budget all of your anticipated expenses for the month, make decisions about where you're going to spend your money, and then you're not going to run out of cash, or you're going to make sure that you've got enough cash to pay your bills. So this is an old example. I'm actually going to pull up an Excel sheet for you guys so that we can do a better example real quick. So let me share my other screen over here. Okay, so here is an example P&L from a fake company that I just made up. So if you guys look here, so we've got this example P&L. This is for a made up company from January 1 to today, May 11th. So here's the income up here. Total income, 120,000. Cost of goods sold was 42,000 for a gross profit of 77,000. Paid all the expenses. Down here, net income, $25,000, right? So remember that, $25,000 net income from January 1 to May 11th. So how much cash, hypothetically, would we have on hand? Well, a lot of people would think, well, I made $25,000, right? So a lot of people would think, well, then I'm going to have whatever I made last year plus that amount plus $25,000, right? It makes sense, but when you really get into how things work in business and reporting, it's actually not true. So we're going to look real quick now at how much cash was actually generated from this company. And so here's the cash flow from the same company, the same example company for the same period. And so here's our operating activities. So net cash from operating activities, and then net cash from the rest of the activities of the company. And so here's the net cash increase or decrease for the same period of time, only $7,487. And the actual amount of cash we have left at the end of the period is not $25,000, it's only $1,300. So the reason for that is because there's a difference between the cash flow statement and the income statement. The actual cash provided by the operating activities of the business was only $10,750. And then we had some investing activities. There's actually a couple of misclassifications up here. These should be in a different section on the cash flow statement. But basically where all the extra money went was to pay off the credit card. Remember how earlier I said, if you're missing cash, go look at your principal payments on any loans that you have outstanding. And this company has a significant amount of credit card debt, and they're trying to pay that down really aggressively. And so over the past, 4.5 months or so, they have paid down that credit card debt by about $15,000. And so when you say, well, we've got $25,000 in net profit, but only $10,000 in cash flow from operations, where'd that other $15,000 go? This is where it went. It went right here to pay off this credit card. So that's why it's so important that you are always looking at your P&L and always looking at your cash flow statement, because these two things can be significantly different. And you might not actually have $25,000 in your bank account. You may actually only have $1,300 in your bank account. So as you can see, that's really important to keep track of. All right, let me get back to the PowerPoint. There we go. Okay, so how do you budget to make sure that you don't run out of cash? So first, you want to analyze your past data, look at your past spending habits, and try to project those forward. Then you want to allocate capital, which is just a fancy way of saying make decisions about where you're going to spend the money. Then you want to monitor the spending. So you need to be able to go back and check every single month how much you spent compared to how much you actually budgeted for. And then having accountability. So if you've got managers that are managing departments or managing one or two departments, I realize a lot of you guys are probably small businesses. So you may not have but more than like one manager or so, and that's fine. It may even just be you. There needs to be accountability, for those budgets. So if you agree to a budget at the beginning of a period, say we're going to spend $10,000 on this, and then spend $20,000, they go way over budget. There needs to be accountability for that, so they don't go over budget, so you don't run out of cash. And we've got some budgeting templates here in-house that I can help you with to put a budget together. We can create something custom for you. Also, you want to look and plan for other sources of cash. So if you know that you're going to have a cash shortage coming up soon, you want to start looking into other sources. So go ahead and plan to get that debt now rather than the last minute, because it usually takes anywhere from a month to 3 months if you're talking to a bank or even a credit card sometimes to get that debt to be able to meet those cash shortfalls, investments as well, and also trying to project your profits. All right, so just real quick, the key tools you want to use are your financial forecasting, which I'm going to help you set up. I've tried to explain this in a webinar before that didn't go that great, but basically this is the format it kind of looks like. We just do our starting cash inflows minus cash outflows, and that gives you your net cash flow and your net cash balance. This looks really complicated. I would rather go over this with you one-on-one through a Zoom call or in person if you want to come into the office to really help you with this tool. But this is the primary tool that most businesses use to make sure that they've got enough cash to pay their bills month to month. And it's just called a cash flow forecasting tool or a cash flow forecasting template. You can download them online from several different websites. You can literally just go to Google and just Google cash flow forecasting template, and it'll, there'll be several that'll pop up. But this is the main thing that I help people with out on a day-to-day basis. I'd be really happy to do that with you if you want to get in touch. If you're not in the Northwest Arkansas area, there are other consultants at the other universities that we have across the state. They'd be more than happy to help you with this as well. And then most of you have probably made a budget at least once in your life before. If you haven't, that's fine. But a budget is just simply writing down like, hey, these are my anticipated expenses. These are the things I spend money on every single month and every single year. And then just try to kind of estimate what you're going to pay for them. And then just make sure that you're making enough money to cover your expenses. And if you're not, that you've got a plan to go out and get some cash at some other sources. Yeah. So that's it for now. Would love to talk with you guys one-on-one. Again, if you've got some questions, I would really appreciate you just putting them in the Q&A or in the chat box, and we can chat about that for just a few minutes. I'm going to be around for a little while until we get all those answered. So if you've got questions, now is the time. Yes, the recording will be available on our website. Sometimes it takes a day, sometimes it takes 2 or 3 days, but it will be available for sure. Any other questions? All right, well, I am here for you guys for a few minutes if you think of anything. That was right at 30 minutes. Any other questions? I'll give you a minute to type it out or just maybe form it in your head. Just keep in mind that the biggest mistake most people make is just choosing not to actively manage their finances. And so really, if you'll just do that, a lot of this will take care of itself. I'd be really happy to talk with you about it. Just get in touch. All right. Great to see everybody. Thank you so much for being here, and we'll see you next time.